So today we are going to be talking about chapter 19, which is professional conduct, independence, and quality control. These are just some standard definitions of ethics and professionalism. Make sure to read through them on your own, but I don't want to, have to read them out to you. One thing to make note of is, yeah, all professions have rules of conduct. So basically everybody knows what to expect, right? The professionals themselves, the users who are buying their services, etc. Like everyone needs kind of a standard so we know what is acceptable behavior and what is not. And when there isn't acceptable behavior, we need to be able to punish people based on a set of rules. Now, with respect to auditing and professional conduct, we have a couple quotes here from judges from legal cases involving auditors. And basically what these judges are saying is, hey, an auditor really is selling their independence and objectivity. Audit services are not all that valuable if you don't believe an auditor is independent and objective, right? And we talked about this in chapter 1. We said, hey, if shareholders really didn't believe that the auditors were working for them and that the auditors were objective, if they thought the auditors were under the thumb of management, then you'd have no reason to pay auditors millions of dollars in some cases to audit your financial statements, right? The reason we're willing to pay them so much, the reason auditing is this huge for-profit business is because auditors are selling their independence and objectivity, and everybody believes it and trusts in it. So where do our independence standards and ethical guidelines come from? Well, they're predominantly coming from the AICPA's Code of Professional Conduct. So you'll see for private companies, basically they're using the AICPA's Code of Professional Conduct. For public companies, yeah, technically this is governed by the PCAOB, but all PCAOB did was adopt AICPA's Code of Conduct. So basically they're under Code of Conduct too. Now for public companies, they do have a few additional more stringent rules added on by SEC. But what you'll see throughout this lecture today is basically us walking through AICPA's Code of Conduct, and then here or there, we're going to have extra bonus rules that public companies also need to follow. Okay, and then there's also something called the ISB, or Independent Standards Board. It was a really short-lived cooperative effort between the AICPA and SEC, and they only issued a handful of standards. They are technically still applicable, meaning everyone still has to follow those standards, but they're relatively insubstantial and just a few standards compared to the AICPA's Code of Professional Conduct, which is a massive set of rules that we all have to follow. I linked a little article here on the ISB if you're interested in learning more. So within AICPA's Code of Professional Conduct, they start off with principles of conduct, and then they have a layer of rules and a layer of interpretations. So the thing to remember about the principles is those are kind of ideal and generally quite vague ideas of, hey, these are like the principles we should live by. All auditors should be ethical. All auditors should have integrity when they're fulfilling their duties, things like that. So rather vague. Yes, they are kind of these ideals we should all live by, but they're so vague that they can't possibly be enforced. That's why we have the rules of conduct, which is really going to be kind of the meat of what we're talking about today. So these are the minimum acceptable standards that all professionals have to follow, and they are specifically enforceable because they're clear guidelines, like you can't own shares of stock in a company you're auditing, right? That's a clear rule that people can either follow or not follow. And if they don't follow, then we, can punish them. And then we have interpretations of the rules where necessary. So if there is a rule where there seems to be some room for judgment, then we'll have these detailed interpretations that help spell things out and help make the judgments a bit easier. So this is sort of the preamble to the Code of Conduct, and we go through the 6 principles here. They're all very straightforward, so I'm not going to spend much time on this. We see there's a principle that when carrying out responsibilities, people should be making moral judgments. We're working on behalf of the public interest. Make sure to maintain integrity. Make sure to maintain objectivity and independence. Remember to take due care when you're going about all your tasks and duties. And make sure you're not providing any services that just the providing of the service makes you violate the rules, right? So like, don't accept clients if you know you're not independent. Now, this is the current layout of the code of conduct. And we're going to be talking through each one of these things in more detail. This is just the overall layout as it exists right now. You don't need to worry about things like memorizing section numbers for the purposes of our exams, and also generally not for the CPA exam. You don't really see CPA questions where they're saying, what's section 1.200.001? What is it? 4 choices. I mean, we wish CPA questions would be that straightforward and easy, right? So let's talk more about the integrity and objectivity rule. So this is just saying that when you're providing professional services, you need to maintain objectivity and integrity, don't have any conflicts of interests. And this segues into the independence rule, which states that the auditor must be independent in both mind and in fact, and maintain professional skepticism at all times during an audit. So we have this sort of spectrum, which helps us to define professional skepticism, where at one end of the spectrum, you are extremely gullible, right? And you believe everything that the client tells you at face value. Right? You're just like, oh, okay, yes, you're saying it, therefore it must be true. On the other end of the spectrum is extremely skeptical. So this means we automatically assume everything the client tells us is a lie, right? Assuming the clients are trying to be dishonest with you. What we need to remember is we want to stay somewhere in the middle here, right? Somewhere in the middle is best, where we don't just gullibly believe everything the client tells us, but we also don't assume everything is a lie. And let's go back and briefly talk about this whole thing about independence in mind versus independence in fact. So independence in fact is generally seen as whether you are independent following all the rules and guidelines. So are you financially independent of the client, making sure you don't own stock in the client company, making sure your husband or wife doesn't work as the company's CFO. Things like that are making you become independent in fact. In terms of independence in mind, this is the idea that in your mind, it's not really measurable, but in your mind, you are objective, independent, you're not biased, you're remaining professionally skeptical. So independence in mind is a bit more judgmental because we don't really have particular rules to enforce it. Independence in fact is more easily enforceable because there's like a clear set of rules that you need to follow to be independent. So the requirement here is if you work on attestation services, so remember our circles, right? We have audit, attest, assurance. If you're working on the attest services or attestation services, you must be independent. Okay, so this can include financial statement audits, quarterly financial statement reviews, and other services. And we talked about some of those, I believe, in the very end of chapter 1 when we walked through the 3 types of services. If you are a covered member, you must be independent. This begs the question, what is a covered member? And we have a slide on that. So covered members include people on the engagement team. So these would be like all the individuals from the lowly staff up to the partner. All of them need to be independent if they're on the engagement team. Now let's skip number 2 for a minute and come back to it. So we're going to look at number 3. So number 3 is any partner or equivalent who provides more than 10 hours of non-attest services to an attest client within any fiscal year. So let's say you have a partner or manager that just does a few hours of work for the engagement, but they're not necessarily a part of the official team. So you could have like a tax partner, evaluation partner, doing a few hours of work here and there. If they're over 10 hours, they are considered a covered member as well. And basically, remember, if you're a covered member, you just have to follow all the independence rules that we're going to go through in a minute. So you have to be considered independent. Number 4 is all other partners in the office from which the audit team is operating are also considered covered members. So if we're all working out of the Atlanta office, all other partners in the Atlanta office are considered covered. Partners in the Charlotte, North Carolina office would not be considered covered. The firm, including the employee's benefit plan. Now, to think about what this means, because this is a bit confusing, let's think about what it means to be independent, right? So we said there are rules, independence rules, saying you can't own shares in the company you're auditing, right? You can't own stock in the company you're auditing. So this means, in the context of that, this means that EY as a firm and EY's 401k plan also should not be investing in the stock of companies that we audit, right? If we're auditing Coca-Cola, then our benefit plan should not be going and sinking 10% of their assets into Coca-Cola stock. Number 6 is basically saying an entity that is more or less controlled by any of these people above is also considered covered. So think about for this something like a joint venture between an audit partner and the CEO of the firm, something, right? Like if technically it's the partner or covered person who is controlling that joint venture business. And so that business then should not be allowed to be investing in the company being audited. Okay, now let's go back here. Number 2 is almost a catch-all at this point. It's basically saying we covered the engagement team members, we covered all the other partners in the office, we covered the firm's employee benefit plan. Now, anyone else in a position to influence this engagement needs to be independent. So this could even be like the people so there are usually individual offices where the partners work out of, but then there's a national office, right, where the CEO of the audit firm works. And also you have people that kind of can provide advice to all types of engagements, right? So if you have somebody that could possibly be providing advice to engagements on like whether or not it's okay for the company to do this specific accounting thing, like are they allowed to account for this acquisition they've done in this way? And the lead partner isn't sure, so he'll send the inquiry up to the national office. So those people at the national office, the firm CEO, they are in positions to be able to influence engagements. So it's important that they all be independent too. So that's why they're falling under this covered member definition and this kind of catch-all that is number 2. So remember, if you're a covered member, you have to be independent. So what does independent mean? So now we're going to talk about basically what independence means, and specifically this is really independence in fact. You cannot have a direct financial relationship with your client. So this means I am directly investing in the stock or shares of the client, right? I have equity interest in the client. And if it's a direct investment, materiality is irrelevant. So it doesn't matter if the audit partner has 1 share, it's a violation. If the audit partner has like 10,000 shares, it's a violation, right? But even if it's just 1, still considered to be a violation. Now, for indirect financial relationships, they must be material in order to be prohibited or forbidden. Okay, so let's talk about what the indirect financial relationship is. So this could be like I, as an audit staff, right? I am an audit staff for our Coca-Cola engagement team, and I invest in a mutual fund that's like a market index fund. And one of the stocks that that index fund holds is Coca-Cola. So now we see there's no direct financial relationship there. There is an indirect one because there's this added layer of the mutual fund and the staff member who's investing in the mutual fund doesn't really have direct control over whether that mutual fund buys or sells Coke stock, right? So in this case, materiality is important. And we need to think about, what does materiality mean, right? And this is where there's a little bit of judgment and interpretation coming into play. And generally they say something is material if it is over 5% of an individual's net worth. So let's say we have the case of the auditor working on Coca-Cola audit, and we know that this individual's net worth is $10 million. Let's say they're an audit partner. Okay, so that's not too far of a stretch if they've been an audit partner for a long time. Now, let's say they have an investment in some Fidelity index fund that invests in Coca-Cola stock, and their investment in that fund is $500,000. So now we would want to know the percentage of that index fund that invests in Coca-Cola. So let's say 5% of that fund is Coca-Cola stock, right? So this means I want to multiply that 5% by their $500,000 investment. And then I figure out that there's $25K invested in Coca-Cola effectively. Coca-Cola indirectly, right? Because we know this is an indirect investment. That's why materiality matters, right? If this were a direct investment, even $1 invested in Coca-Cola would be forbidden. So now what we need to know is what percentage of net worth is the 25K investment. I should say indirect investment. So we just divide our 25K over our 10 million, and we find out it is 0.0025 or 0.25% investment. So this falls below the 5% threshold given to us by the interpretation in the independence rules. And I believe it's interpretation 1.240. Basically, this is what happens. You do this calculation and you figure out if the indirect investment is material to that individual or not. If it's material to them, then they're not allowed to have that investment. If it's considered immaterial to their net worth, then it's completely fine and acceptable for them to have that investment. And one thing I want you to remember is to make sure you know your exceptions to these rules. So these rules have lots of little exceptions, like if you're getting a mortgage from the bank or a car loan for the bank, then you could still technically audit the bank, or you can audit whoever is providing the financing. And the thinking there is something like a car loan is something that everybody has to get from somewhere, right? And there tend to be, when you look through the ownership structures, there tend to be not that many financial institutions that give out car loans, right? So basically it would be considered to be asking too much for professionals to have to like hunt down the one car loan financing company that is not, that their firm has no relationship to. And you'll find a lot of these exceptions on page 645 of your textbook. So make sure to read through that and take notes, because a lot of times what we'll see is these types of questions on the CPA exam. And because they're on the CPA exam, I will give them to you on your exams in this class. So you'll see these types of questions. So let's read through this. I recommend you pause me and then pick me back up when you make a decision. Okay, so let's read through this question. In which of the following circumstances is a CPA who audits XM Corporation least likely to be independent? A is the CPA and XM's president are both on the board of directors of some third unrelated company. This doesn't seem to violate any of the rules we've talked about, so this seems okay. Choice B, the CPA and XM's president each own 25% of FOB, a closely held company. In this case, FOB is going to fall under number 6 in terms of being a covered person. So FOB is a covered person. So it's a problem that basically the CPA and XM's president both own such a huge percentage of it. Right? And to think about this logically, basically this means the CPA and XM president's financial destinies are tied up together. And whenever you have something like this where somebody's financial destiny is tied up with somebody else's, that's usually a sign that these two parties are not financially independent. So even if you didn't know the specific rule, this is a good gut check to help us see if something is an independence issue or not. The CPA has an auto loan from XM, which is a savings and loan origination. The loan is collateralized by the automobile. So this is where I was talking about. You need to know your exceptions from page 645 of the textbook, because let's say you're just reading this and you're going through with your whole common sense approach rather than the actual knowing the rules approach. If I'm just going through with common sense, yeah, it kind of seems like a problem that the CPA has a loan from the company. But if I know that this is an exception, I'll know that C is not the right answer and I'll be able to move on and pick from the others. And D, the CPA owns 1% of the stock of a diversified mutual fund investing in XM. Okay, now depending on the size of this indirect investment, right, it could cause an issue or it may not cause an issue. So this is where you kind of need to determine, run the numbers and see if it's more or less than 5% of the CPA's net worth. Now, because this B is definitely a problem and D is only a problem if this exceeds 5% of his net worth, that means B is the best answer here. This is another thing you'll see a lot of in audit questions. It's not about, there's no like black and white perfect answer. It's all about picking the best answer to the question being asked. All right, and D is not our best answer here because this could be completely fine. I'm always going to take the answer that's where I know there's an issue over the answer where there might be an issue.